Hello, my name is Marley, and today we'll be looking at the finances of Amazon Inc. First, we'll look at their effectiveness of their financial management, and we'll look at that from an investor's perspective. Then we'll go ahead and look at some of the future innovations and advancements of Amazon.
Amazon was founded in 1995 by Jeff Bezos. It started originally as a bookstore, and then based on customer review and lots of feedback, he decided to go ahead and expand into music, movies, and video games. Within those first 4 to 5 years, they decided that they weren't really focused on making a profit, really just wanted to get the feet underneath them, and then in 2001 is when they first turned profit. During the beginning part of the process, Jeff's parents were really heavily involved in helping support the business and his future endeavors. Now, Amazon is one of the largest online companies, and they offer 12.3 million products for online purchase available around the world. Looking at their financial management, however, there are some concerning things as far as Amazon's management. Current ratio, we can go ahead and see a current ratio is pretty evenly 1 all the way across the board for these past 6 years. A current ratio below 1 indicates that they don't have enough assets to go ahead and cover some of their liabilities. A current ratio above 3 indicates that they have too many assets and that they're not efficiently and effectively using those assets. So a current ratio right around 1 is really where they want to be. That's great shape for Amazon. Jumping down to the quick ratio, we can see that this is where we have some hesitation as far as Amazon's financial management. The quick ratio indicates the amount of cash you have on hand to pay your current liabilities. So in this case, in 2011, if I had $1 that I owed somebody, my quick ratio with 0.81 would indicate that I only have 81 cents in order to pay them back, which is a pretty negative thing as far as Amazon's finances go, considering that all of those numbers are below 1. So they really don't have enough money to pay back their quick cash liability payments. Looking at the return on assets, we can also see in 2011, 2013, 2015, and 2016, they were just above 1. This is the amount that they're going to get back from the assets that they're investing in the company and the amount that their shareholders are investing into the company. So really, ideally, we would like to see higher return on assets, which means that they're utilizing assets effectively and getting a large profit from those assets. In 2012 and 2014, they actually had a negative return on assets, which is really alarming as far as an investor kind of looking at Amazon. Then dropping down to that last table, we can go ahead and check out their profit margin analysis. As you can see with their operating profit and their net profit, they are just barely above 1 for a lot of those. Some of them are negative and some of them are just barely above 0 as well. So for the most part, this negative margin, profit margin, really indicates that they're unable to make a large profit. They're right at that break point even for their operation, but they're not making a large profit at all, which is kind of concerning. From an investor perspective, we can also go ahead and consider some of the things that an investor would be considering, like their dividends. So for example, on their 10K, they write, "We've never declared or paid a cash dividend on our common stock." As an investor, considering this as a potential investment, you would want to have some type of dividend paid onto the stock, either once every 10 years or some type of payment that's coming out of your investment. And for Amazon, they haven't even done that yet. So finding investors is definitely more difficult. That short term is not really turning over very fast, and so they're not getting a lot of investors from that. We can also go ahead and check out their retained earnings, which as you can see is starting to drop. So retained earnings was increasing until 2014 and then started decreasing. A decreasing retained in earnings means that the company is investing less back into their actual company. With the high percentage of retained earnings, they are investing a lot back into the company, and all of the assets and things that they're gaining as far as company capital is then getting reinvested back into the company. But here you can see that the percentage is pretty low, as well as the actual amount of retained earnings, and this is of course in millions, but both of those are pretty low indications that show that the company isn't really doing a lot of self-investment, investing back in themselves, which can be a concerning thing. The other thing to consider when we're looking at the investor's perspective is their perspective coming from a bond issuance. So Amazon does have a lot of bonds outstanding currently. In 2014, they issued $6 billion worth of bonds, which is debt equity, and all of those bonds would be paid back within the next 6 years. So these bonds are really like a loan from somebody, a personal loan from a person. Most of them are costed about $100, so you'd buy a $100 bond, and then at the end of those 6 years, you get paid back. Amazon has a lot of those currently outstanding, and I think as we start to look into their future outlook, we'll be able to see that they have a lot of capacity to pay those back efficiently. Considering the future, they are definitely tapping into an online population that is starting to online shop like crazy. Most of my friends and myself included definitely utilize Amazon while we're sitting there thinking about something. As soon as your purchase is on your mind, you can hop onto Amazon and buy it right then. So the online shopping is definitely a growing market, and it is definitely increasing the sales that Amazon is getting. They're also starting to look at their own delivery systems. So this means having types of drones, having some type of truck system, and that completely removes the middleman as far as delivery. So a lot of things coming down the line for Amazon as far as development, building, and growth and innovation. One of their biggest innovations as well is Amazon Go, which is essentially a store where you'd be able to log into your Amazon account, you'd swipe in with your phone, you'd get whatever you want, put it in your basket, and walk out. No lines, no checkout, just like this image indicates. So that is really an interesting type of development that Amazon is considering. It would drastically change the landscape of shopping as we know it today. Overall, considering Amazon's finances, if we consider their lack of profit margin, lack of large profit margin, as well as their lack of retained earnings, from a stock investor's perspective, I wouldn't get involved. However, if you consider their long term and you consider some of the things that you may get out of it by investing in a bond, there is really a lot of potential for Amazon as a company to invest in. Thank you so much and have a great day.